Bonjour tout le monde. Good morning, everyone. My name is Paul Bennett, and I'm a director on the board of the Ottawa Branch of the National Association of Federal Retirees. I would like to begin by acknowledging that the land on which the branch office is located is traditional unceded territory of the Algonquin Anishinaabe people. On behalf of the branch, I am pleased to welcome you to today's webinar, Renting versus Owning Real Estate, and it's proven to be a popular one. We have close to 400 participants today. Today's presentation is with none other than Michael Fine, who is a branch member and longtime presenter with the Ottawa Branch. Over the last 6 years, Michael has designed and offered very popular workshops and webinars on investment matters that have reached over 1,800 of our members. Michael has an MBA and has successfully completed the Certified Financial Planner courses, although he has never worked in the industry. He has spent a lot of time managing his own family's financial assets. His views are his alone, and he receives no remuneration for these events. He is dedicated to helping retirees get the information they need to make well-informed investing decisions. Now, before I turn things over to Michael, I do have a few things to cover. Premièrement, veuillez noter que le webinaire sera présenté en anglais, mais la participation bilingue est toujours encouragée. I also want to give a special welcome to anybody here who is not yet a member of the association. We hope these webinars will inspire you to join us, and to our members, we hope that they will encourage you to maintain your membership. Michael has designed some poll questions for today's presentation. During the corresponding point in the presentation, a poll question will pop up on your screen. Select your answer and click Submit. Michael will then discuss the results. These polls are, of course, completely anonymous. Today's webinar might go over our allotted time by 10 to 15 minutes. If you need to leave before we conclude, you will still receive the full presentation recording to view later. There will be a question and answer period at the end of the session. Please type your questions in the Zoom Q&A box throughout the presentation, and Michael will answer them during the Q&A period at the end. Now, I'm going to turn the presentation over to Michael.
Thank you very much, Paul. And thank you very much, ladies and gentlemen. Good to see you today. Let me see if we can get the slideshow going here. There we go. So basically, what we're going to talk about today is it a better choice to rent versus own for seniors? And whether or not the glory days of real estate investing, which you know has been very hot over the past 25 years or so, whether or not the glory days are over. One thing we have to do is the disclaimer that nothing in this presentation is advice or recommendation. I don't know you personally, so there's no way I can give you personal recommendations. And a reminder that all investing, if you're investing in real estate, it does, of course, involve risk, just like investing in stocks. And, of course, that you should seek the advice of a registered advisor for making any investment. So here's the first poll question. And so I can't see if it's up on the screens or not, so I will assume, oh, there we go. Okay. So take a look at these and pick an answer. So real estate does well when interest rates are declining, the economy is growing, the population is growing, or all of the above. Please vote now. Okay, I think Antoine, pretty much everyone has voted. So the results that most of you have chosen is all of the above. And you're right. As we're going to see, real estate has done well as interest rates have declined over the past 40 years or so. And of course, it does well when the economy is growing, population is growing. But all of these together really produce significant growth in real estate. And what I'm going to show you is that that is what we've had over the past 25 years. But I caution that it may not be the case going forward for a number of reasons. So we'll stop sharing that. So take a look at this. This is long-term results from different types of investments. This goes back all the way to 1928. And you can see that over that time, stocks returned the highest amount, 9.8%. That includes both the capital gain and distributions, dividends. And then you can see bonds and gold, and real estate is down here at 4.2%. And over that same period of time, inflation was 3%. So real estate did beat inflation by a bit. Now, the numbers for real estate are actually better than this for most investors because, of course, most investors use leverage when they buy real estate. That means that they get a mortgage. So you might put down 20% or 30% of the total cost. And that means that your real return is much higher than the 4.2%, as long as you get the growth in the value of real estate. And what I'm going to show you is that there could be long periods of time where that does not happen. I know there are some folks on the line who are not from Ottawa, but I use the Ottawa numbers just to have a central place of reference. So back in 1998, the average price of a home in Ottawa, believe it or not, was $144,000. And today, the average price is $654,000. That is an average annual compound return of 6.2%. Now, remember, we said the average long term was 4.2. So the last 25 years have been substantially higher than the long-term average. Now you say, well, it's only 2%. That's not that much. Well, it is. Over 25 years, 2% times 25 years is over 50% when it's compounded. So what you can say is about the total growth over the last 25 years was significantly higher than the long-term average. The reason why, to a great extent, was because interest rates declined so much. Now, most of you are old enough to remember the early 1980s when mortgage rates hit 18, 19%. And so here's an example. So in 1982, the 5-year fixed was 19.3% average. The variable was 16.2. Now look what happened over the next 40 odd years. By 2021, the variable rate was down to about 2.2. And in fact, at certain points, it hit 1.5. And even the 5-year fixed was down to an average of 4.8, and in certain periods hit 3. So there was this huge decrease in interest rates over the last 40 years, and particularly also over the last 25 years. And that, my thesis is, has had a very strong impact on the rise in the price of real estate. So here's the next poll question coming up. So Antoine, if I can get you to bring up the poll question. So over the next 5 years, I expect that interest rates will what? Increase a little, increase a lot, decrease a little, decrease a lot, or stable the same. Looking forward to your opinion. Okay, I think everyone has voted by now. So let's see the results. So you can see that the most of you think that interest rates are going to decrease a little. Now, there's no right answer because this is opinion, of course, but it's interesting to see what people think. About 21% of you say it'll stay about the same, but 56% think it will decrease a little. Not many think it will decrease a lot, and not many think it will increase a little, 14%. So it'll be interesting to see. But basically, if the majority are right, that it will decrease a little, it means that you're not going to have this tremendous impact of interest rates continuing to decline as we've had over the past 25 years. Now, here's a really interesting chart. So I've used the 5-year bond rate here, US bond rate, simply because the graph was easier to get hold of. And this goes all the way back to the 1960s. And you can see that when interest rates peaked here in the early 1980s, even the US bond rate, which is lower than mortgage rates, hit 16%. And then you can see how for 40 years until 2022, interest rates basically dropped. And what I also want to point out is that where we are today, which is at just about 4% for the 5-year bond rate. In fact, I checked this morning and it's just about 4%. It's basically where it was back here in the 1960s. And if you look at this graph, most of the time, the interest rate has been above 4% during that whole period of time. Been only these last several years that it's been below 4%. So when people say, interest rates are high today, I say, well, no, not really. They're pretty much normal. And when you think that growth in the United States hit 3.5% last year, GDP growth, a 4% interest rate doesn't seem high at all. So let's look at how interest rates affect mortgage affordability, because again, this will show you why the prices went up so much. And there's a lot of data in this presentation, so I'll take my time going through it. But back in 1981, remember we had 18% mortgage interest rates. Now, if you had a $2,000 a month payment, that afforded you an average mortgage of $132,000, that $2,000 a month, okay? And at the time, this is, believe it or not, what the average house price was in Ottawa. We all should have loaded up then. And you can see over time, as interest rates decreased, that the amount of maximum mortgage that $2,000 a month covered kept going up. So by 2021, where it hit 1.4% as the low, you could get a maximum mortgage of $507,000 for that $2,000 a month. So the total increase in what you could get in mortgage for $2,000 a month was 284%, just because of the interest rate decline. And during that period, the average house price in Ottawa went up by 900%. So we can estimate how much the decrease in interest rate affecting mortgage amount affected the overall price increase simply by dividing this 284 into 900, and the answer is 32%. And this is interesting because other research I've seen came up with similar numbers. So basically, the conclusion from this is that just because interest rates dropped so much from 18 to 1.4, that affected about 32% of the value of, or the pricing of housing. So besides population growth, besides the economy, just that. And it's clear that we cannot go from we went from 18 to 1.4. So let's say that was a 16.6% decline. That cannot happen again, because you can't go from even say where we are now at around 5% down 16 points, because you'd be at negative 11, and that can't happen. So I want to play you this little video. This is a video, an interview with a fellow by the name of David Rubenstein, who's a self-made billionaire, interviewing Howard Marks, another self-made billionaire who runs a major debt lending company worth about 150 billion, called Oaktree Capital. So give a listen to what they have to say.
Let's talk about two memos that you've written not too long ago that are fairly well known. One was written last year called Sea Change. And in Sea Change, as I understand it, and as I remember from reading the memo, you said in your lifetime in the investment world, there have been 3 sea changes. 2 of them occurred earlier, you described what they are, and now there's a third sea change. And that third sea change is basically that interest rates are not coming down anytime soon, and we have to live in a higher interest rate environment for quite some time. Is that fair?
It's about fair. What I would say is that since remember in 1980, the Fed funds rate was 20, and I had a loan outstanding from a bank at 22.25. 40 years later, the Fed funds rate was 0, and I had a loan outstanding from a bank at 2.25. So the decline of interest rates by 20 percentage points over that period was a dominant factor in the financial world. I think it was the most important single event in the financial world in the last 50 years. Doesn't get the credit.
Well, okay, was that the first sea change in your investment
No,
career?
that was really the second. But the third follows on from that. In the period 09 through 13, the Fed took the Fed funds rate to 0 to fight the global financial crisis, left it there a long time, and didn't have any luck getting it back up into what you might think are normal ranges. So we had a low interest rate environment, which made life very easy for borrowers, asset owners. It was easy to run a business. The economy did well. We had the longest bull market in history, the longest economic recovery in history. We had very low incidence of default and bankruptcy. It was an easy world. And if you read articles about, for example, Silicon Valley Bank, they talk about the easy money environment. And the main point of sea change is we're no longer in an easy money environment.
Let's talk about.
So we're no longer in an easy money environment. And I think Howard Marks did a great job of summing it up. And that same thing that drove up the value of stocks, drove up the price of housing, those are what I call the glory days. And as Howard Marks said, I think they're over. So let's take a look now at getting into what it really costs to own, say, a condo apartment, and compare it to the cost of renting. So these are figures that a friend of mine, who's a condo owner, has provided. And we'll just run through, and there's 2 columns here just to explain the difference. This is the cash flow cost. So this presumes that, like, say you're an investor or you're a buyer, you put down 20% or more, and you have to finance the cost of this condo. And this column, called net cost, is the cost overall once you end up selling the condo, because of course, as you pay down a mortgage, you are paying principal off, but you don't get that principal back until you sell in the end. So for most people, we'll focus on cash flow cost. And in this first part, it's either the mortgage cost or the opportunity cost. What's opportunity cost? Well, let's say you paid cash for a $400,000 condo. Well, there's an opportunity cost because you could invest that money and you could make easily 5%, 6% or more today. So I've used 4% as a number to calculate the opportunity cost. Condo fees, in this particular case, these are actual numbers, $885 a month. Real estate taxes, maintenance and repair. I put it in at 1%, and a lot of people miss this part, but it costs a lot to own any property these days. I just put in a new stove. Well, that was $2,000. A new dishwasher, $1,000. Something goes wrong with your plumbing or whatever, $500. Plus, you have to, if you own a property for a long period of time, you have to redo it, bring it up to modern specs. So putting $4,000 a year, 1% is, I think, reasonable. Insurance, $480. So your total amount, cost of ownership, cash flow is about $45,000 a year. So that gives you $3,780 a month. In that unit, in that building, you can typically rent this apartment or similar for $2,300 a month. So that means that you've got a negative cash flow of about $1,480 a month. Now, we look at it at net cost. The negative is only $820, but remember, that's assuming that you're recouping the amount of money that you paid off to pay off the principal in the mortgage. But in either case, you've got what's called a negative cash flow. So how do you make up this negative cash flow? Well, in the past, it's been made up through the price appreciation. And hopefully in the past, the prices weren't so high so that you could buy a place and not have negative cash flow. You could at least break even. But today, very, very difficult to break even. So you need to have the price appreciation to make up this difference over time. Here is another example. This is a one-bedroom apartment. As you can see, the costs are less. But the overall situation is the same, a negative cash flow of about $1,500 a month. So whether you have a one bedroom or a two bedroom, you still end up with this negative cash flow. So how do you make it up? Well, you need, as I said, to have capital gain to offset it. And that's what people have depended upon in the past. So if we go back to either of those examples, the negative cash flow per year was about $17,000. That works out to a 4.4% capital gain needed. Simply 1,760 over 400,000 is 4.4% of your value. As we said earlier, over the last 25 years, the price increase was about 6.2, less 32%, which you may recall I said was the result of the dropping interest rates. That gives you 4.2%. And interestingly, that calculation equals almost exactly what the long-term return has been from real estate. So I think it underlines my point that 4.2% is the norm, and what we've had over the past 6.2%, the glory years, is not the norm and not what you can look forward to going forward. With the net cost scenario, it's a bit less because you don't need as much capital gain because you're counting getting back your principal that you've paid off in the mortgage when you sell the property. So here's another poll question for you. And I'll wait for Antoine to bring it up. So by how much did the number of residential real estate sales in Ottawa decline in 2023 compared with 2022? What's your guess? Okay, I think everyone has voted. So the majority, well, just under a majority, 46% chose 5 to 10%. The actual number was 11%. So the number of sales, real estate sales in Ottawa declined by 11% for 23 over 22. So it shows you that the market can be fairly very variable. A 11% decline is significant. So let's look at the next question. And another poll question. Again, Antoine, if you would bring it up. So by how much have Canadian house prices decreased since they peaked in March of 2022? Okay, again, I think everyone has voted. So 44% of you chose 10%, 31%, 15%, and 24% chose 18%. The correct answer is 18%. 18%. So you remember all those people who told you can't lose money in real estate? Well, a lot of people have lost a lot of money, and it's caused some major problems. Um, in that, for example, a lot of people put down payments for to-be-built houses. And when the houses were actually finished and they came to get them financed, the mortgage company would appraise them at 18% less than they paid for them, and they couldn't get mortgages, and they lost their deposits. Also, they could be sued, by the way, by the builder for the unpaid amount of money, or if he couldn't sell the houses for what they had agreed to buy them for. So housing prices can go down. Now, I want to say a little thing, though. You know, we talk about averages and average returns, and I just want to make the point that there can be a lot of questions and problems with averages. And I use this analogy of a golfer. So my golf partner hit her first shot way left into the water. You can see there. And she took a mulligan, and mulligan means a second free shot for you non-golfers, and hit a big slice way right into the trees. And she swore. And I said to her, look, no problem, because on average, you're in the middle of the fairway. So she didn't find that too helpful. And the same thing can happen with investing, because you can find this on average situation, but in the meantime, there could be some big slices. So here's an example. These are the house prices in the almost a full lost decade in Ottawa, even within this period where prices were going up so much. So in 1990, the average Ottawa house price was $141,000. 8 years later, in 1998, the price was roughly $144,000. That's a total increase of 1.8% over 8 years. And it's an average annual compounded increase of 0.2%. So the reason I use that golf example, yeah, we've had 6.2% for the last 20 odd years. Yeah, the long-term average is 4.2%, but there's also periods where this will be the equivalent of the big slice. You got virtually nothing. And so when seniors are making a decision about owning versus renting, you got to keep this in mind. Now, I'm not predicting that the next 8 years is going to be like this. I don't know. I have no idea. But, you know, it's a case of prepare, don't predict. You have to realize that these kinds of situations happen, and you have to be prepared in case they do. So it comes to the question. It's all about the price appreciation, and can you depend on an average 4.4% price appreciation? So some other considerations about renting. So if you're going to rent and looking at renting, one thing to be cognizant of in Ontario is that there are rent controls on buildings that were first occupied prior to November 15th, 2018. And the government sets how much the rents can go up. And last year, they set it at 2.5%, which was significantly below inflation. So the rent control buildings are obviously advantageous to many people. If you're not in a rent controlled building, basically the owner can put the rent up whatever they want. There's no control on it. And so you've heard the stories about some significant increases in rents. Other important considerations that older buildings tend to be larger, cheaper to rent or buy, fewer amenities. Right now, though, there's very limited selection. There's very little to rent out there. So it makes it very tough. The other thing you have to be concerned about as a renter are what are called renovictions, where the owner, even in big buildings, can come in and say, we want to renovate. There are problems here that have to be fixed. And you've got 3 months to get out. And they can evict you. Similarly, in a small situation where, a family or single owner owns a house or apartment, they can claim that they need it for themselves or their immediate family. And once your lease is up, and let's say you're on month to month, they can kick you out. Another downside to renting is you don't have the ability to renovate or upgrade your unit. And because so many units now are in negative cash flow, the owners are not going to want to spend money that they don't have to. So if you're in an apartment that's kind of seedy, the chances of getting it fixed up are going to be limited. And then, of course, there are always notoriously cheap landlords who just won't do anything. I won't go into the situation I have next door to me, but we've got a house that basically should be torn down, and it's been rented out for the last 5 years. It's awful. So some considerations if you're going to buy. Well, of course, condo fee increases. And there's not much that you can do about that. The condo board has to ensure that there's enough money to properly look after the units. Insurance increases. Insurance is going up a lot, and it's going up because the insurance companies are losing a lot of money because of climate change. Now, it's not such a huge problem here in Ontario, but in other parts of the country where you've got fire issues or flood issues, the insurance increases can be substantial. If you're looking at buying, the one thing you really have to understand is the state of the reserve funds. Those are the funds put aside for future repairs to the building. And a lot of older buildings failed to have enough reserve funds. It was not required until several years ago under law that the reserve funds be maintained. So reserve funds and understanding them are very important, as are unanticipated repairs to the building. There's a number of horror stories where older buildings have given assessments of $10,000 and more per unit because of major failures in the building. And then the other side is rent controls. If you do want to rent your unit someday, if you have an older building, you're subject to those rent controls. So let's just look at an example of a sell and rent scenario. So let's say that you are currently an owner and you want to sell and you want to rent. How does that look? So let's take the average sale price in Ottawa of $650. You can invest that today pretty easily in high quality dividend stocks or preferred shares and easily make 5% today. And the nice thing about dividends is that your tax rate is very low, 15%. If you have dividend income and your taxable income after, say, pension splitting is $50,000 or less, you pay zero tax on Canadian dividend income. So you'll save real estate tax that you don't have to pay. So I calculated that at 0.6%, which seems to be average. You're going to save on maintenance. I calculated that at only 0.5% because it's sort of the annual ongoing maintenance, not the long-term maintenance here. You're going to save on insurance, typically $150 a month. You're going to save on utilities, which are typically $400 a month. So your total income from your invested money and your savings works out to about $41,000 a year. So round it off, let's call it $42,000. So that will support rent of up to $3,500 a month. And for $3,500 a month, I think you could still find a pretty nice rental apartment or something similar. Now, in Ottawa. Now, look at this 650 number. One thing about this is that if you do sell your place and you've got 650,000, clearly you've got to get the services of a registered certified financial planner to help you invest that money. And with $650,000, there will be lots of financial advisors who will be interested in helping you, taking you on as a client. But that would be an absolute must. So what are my conclusions here? And these are conclusions, not recommendations. So if my conclusions are this, if you currently own, you probably want to stay in your property unless it no longer suits you or you're just fed up maintaining it, kind of as I am. And I've got 15,000 square foot lot with a pool, and it cost me a fortune to maintain it. But basically, unless it really doesn't suit you, you're probably right now just better off staying. If you're buying as an investment, then I think I would wait to see if prices drop, because you want to try to get as close to neutral cash flow as you can. And right now we're a long way away from neutral cash flow. If your decision is buying versus renting, then it's really a lifestyle decision that's based on your age and health. You have to be concerned about just how much it's going to take to maintain your own property, although obviously a condo is a lot less. You've got to decide if you've got the funds available to pay the higher cost of owning versus renting. As I showed you, it's substantial until the property is sold. And of course, you would buy because you have a desire to control your own lifestyle. So it's very difficult to give people specific advice on this. It's up to your individual situation. But you can see that in general, it costs more on a monthly basis significantly to buy versus rent right now. So that's why I say I think the glory days of real estate investing are over. I think that we're just not going to see the price increases that we have over the past 25 years, and we're going to have to get used to higher interest rates for a longer period of time, and that's going to affect the value of all assets. So as some of you know, I like to have a little song to sum up the presentation. I tried to get Taylor Swift to write a little song for me, but she was busy. Something about a football player, a trip to Japan, a football game. But I was able to get Bruce Springsteen, so here's a little ditty that Bruce wrote. Anyway, the glory days. So that's the end of the presentation, and I'll turn it back over to you, Paul.
Thank you very much, Michael. That was a very illuminating presentation. I know there was a fair amount of data in there, and I suspect that some of the questions will relate to that, as you alluded to earlier. I would remind people that they can pose questions at the bottom of your screen under Q&A, and that we may go a little bit late today, depending on the number of questions that we have. The first question, can you comment on potential government tax on capital gain on the sale of the principal residence?
Well, that's an interesting question. Obviously, the current government is very hungry for tax revenue. And I mean, they're looking everywhere. They're even increasing the tax on beer by 5 cents a can, I think. My personal feeling is that any government who tried to tax the capital gain on a personal residence would not be a government very long. I think that's something that Canadians feel is absolutely their right. And I don't think it will happen. Lots of people talk about it, mainly on the more, shall we say, left side of the political spectrum, because they think that all these people have made so much money on their houses. But I personally just don't think it'll ever happen.
Okay, thanks, Michael. Another question relates to the decline in sales. Was the 11% decline in sales due to fewer listings or fewer actual sales?
Well, I think from what I've read, it was a combination of things, that there was a shortage of listings. And even today, there's not a lot of listings. But it was also, I think, people's inability to pay. As the interest rates went up substantially from, say, 2-3% to 6% almost, people simply didn't have the ability to get the mortgage to pay for these more expensive houses. So I think it was a combination of the two things. But definitely there are also a lack of listings. People are hesitant to put their places on the market. In many cases, it's because they have already, say, a mortgage at a good rate, and they don't want to have to get a different mortgage at a higher rate if they move. And also, those things just aren't selling. I was doing some investigation in the Westboro area the other day. There's a number of newly built houses that have been on the market for over 100 days, 150 days, and they're not moving. But maybe the reason they're not moving is that the price on them is approaching $2.5 million for a 3 and 4 bedroom house, on a lot 33 by 100 in Westboro. So I think it's the combination of the two things.
Thank you. Another participant asks, I've seen recent stories of tenants refusing to pay rent or leaving the rental unit and cannot be evicted due to backlog at Provincial Review Board. This means no rental income and an inability to sell the unit. How does this factor into assessing the risk of being a landlord?
Well, it's an absolutely terrible situation. I mean, I can't believe in Ontario we've got this residential tenancies board, or whatever it's called, tenant landlord board, that's backed up a year. And so you can be sitting there with a non-paying tenant for a year. And for a lot of small landlords, that's just impossible. They've got to keep paying the mortgage, the taxes, and they've got no income coming in. So it's absolutely a ridiculous situation. And I don't understand why the current government in Ontario hasn't acted on this. Having said that, I personally would never want to be a landlord, particularly in Ontario with the rules that we have. You can say to somebody renting your place, can't smoke, no pets, and they can come in and start smoking and bring in all the pets they want, and you can't do a thing about it in Ontario. They can wreck the place and you can't do a thing about it. And as this questioner pointed out, they could sit there for a year and not pay rent, and it'll take you a year to get rid of them. Personally, if you want to invest in real estate, I think you're a lot better investing in what are called real estate investment trusts. You can get a number of them which own thousands of apartments or houses. Let them do all the management for you, and you just sit back and collect your 6% distribution every month. And to me, that's a far better way to own real estate than buying and renting it out yourself. And also, I hate having to fix broken toilets. So.
Another question relates to the difference between Ontario and Quebec. So far, you've referred primarily to the situation in Ontario, but do you have any comments on the difference between owning or renting in Quebec and Ontario?
I don't, Paul. I haven't looked into the situation in, say, Gatineau. I do know that overall housing prices are considerably cheaper in Gatineau, but I do not know by how much. But I suspect rents are also cheaper in Gatineau. So I haven't looked at it, it would not be appropriate for me to comment.
Given your presentation, the cost of renting a luxury apartment like a Lapine one is close to $5,000 a month. How would you approach paying that kind of money? Under which financial circumstances would this be a good decision or make sense?
Well, I know a couple of people who are in the Lapine apartments. They're paying about $4,500 a month, actually. And they are nice buildings, although I've been in the apartments and boy, are they small. In their cases, both of them sold houses for about $1 million. And they've taken that money and invested it. And it works out. If you've got $1 million or so to invest, and you invest it wisely in good dividend paying things, and you count the money that you save from taxes and maintenance and other things, then that $1 million pays your $4,500 to $5,000 a month rental in a Lapine apartment. So the short answer is make sure you have $1 million to invest before you move into a Lapine apartment.
All right. With regard to your point on rent controls on buildings first occupied prior to November 15th, 2018, that would mean it is irrespective of someone renting a unit in such a building today. So the date would not be the renter's date, i.e. post 2018.
Yeah, the way it works is that, as I say, any building first occupied prior to November 15th, 2018 is subject to rent control. So here's how it works. You're in the building now, and the annual rent increase time comes up, and your rent can be increased only by the amount that is prescribed by the government. And last year it was 2.5%. Now, let's say you're just moving into that building now. Well, the owner can set the rent at anything he wants when you first are entering it. So the 2.5% does not apply anymore. They can increase the rent 10, 20, 30, whatever the market will bear. But once you're in, you're subject to the rent controls. So I hope that's clear that while you're in there, you're subject to the rent controls, but when you first move in, it's the market price that you're going to pay.
Yeah, I think that's what the questioner was asking. When calculating cash flow on the rental of a condo, how do you handle the mortgage payment that goes toward the principal?
Well, in the cash flow model that I used, and you can go back and see this, it'll all be available on the Ottawa website, where I call it the cash flow model. That includes the payment of the mortgage principal. Because if you take out a mortgage, clearly you've got to pay off that principal, and that goes to your cash flow. The column beside it, the net cash or cost situation, deducts that payment for the principal and says, okay, well, we won't count this here because you're going to get that back at some point because it's actually your money, right? You're not just losing this out the door. But for calculating the actual monthly cash that you need to own that apartment, it includes the payment of the principal in the mortgage.
Okay, the next question is from a couple that clearly is on the cusp of making a decision. In the case of needing more cash flow to support living costs, is it a good idea to sell and rent and then live off the money made from the sale? We're speaking of an older couple in their late 70s and early 80s.
Well, again, you know, it's obviously a very personal decision. I, as I say, know a number of people who were in their early 80s who decided to do just that. They sold their houses, and both of them moved into one of the Lapine buildings, which are nice buildings. They're very well maintained. And they had enough money to be able to do that. So I think the first thing that you've got to do is find yourself a good financial advisor who can run the numbers for you. And as we showed earlier, let's say that you're going to move into an apartment that's going to have to, you're going to have to pay $2,300 to $2,500 a month for a 2-bedroom apartment. To support that, you probably roughly need to be able to invest $500,000, and you have to invest it properly. That doesn't mean buying GICs. That means buying things that are going to pay you dividends, and those dividends are going to continue to grow over time. And obviously, for most people, you need a good financial advisor to help you do that. And if you've got $500,000, you'll find a good financial advisor, I think. But the you know, the thing is that today it's actually a good time to invest because a lot of the big blue chip Canadian companies that pay very good dividends, their price has been beaten down over the last year or so. So to just give you some examples, Enbridge, which is pretty solid company, not going to get a lot of growth or excitement, but it's going to continue paying its dividend. Its current dividend is around 7.2% per year. Same with TransCanada, what used to be called TransCanada, TC Energy, paying over 7% per year. Some of the banks are paying 5% per year dividends. And as I mentioned, one of the nice things about dividends is that they are taxed less than interest. So typically, I'm getting off topic here a little bit, but typically to get the interest equivalent of a Canadian dividend, we add 30%. So let's say in the case of Enbridge, 7% is the dividend. At 30% of that, that's 9.1%. That's the equivalent of 9.1% interest before taxes. So basically, yeah, it's very doable. The question is, how much is your current house worth? How much can you sell it for? Can you find a good financial advisor? And by the way, not your bank branch, because they don't have the ability to sell you these types of, or help you buy these types of investments. You need an independent financial advisor. And to put it together so that you can feel confident that over time, those dividends will increase, and as rent increases, and that you'll be in good shape.
All right. As I mentioned earlier, we'll likely go over till about 11:15 or 11:20, given the number of questions that we've got, and hopefully people can stay until the end of that. Now, this next question relates to some sort of public intervention. Can owners struggling with high interest variable mortgage rates expect some relief anytime in the near future?
Well, not that I've heard. I know that the banks are being actually pretty what shall I say, liberal about how they are dealing with people who are on adjustable rate mortgages. And a number of them have caps on how much the individual has to pay per month, regardless of what the interest rate is. The problem is that some of those are getting into negative amortization, which means that what you're paying is less than what the real cost is of that mortgage today. And that unpaid amount is getting added to the principal. But, I don't see that the governments are going to intervene to help people out in this case. It's, the problem with governments right now is that they don't have any money. They're massively in debt. In Canada, we doubled the total debt over the last 4 or 5 years. The debt payment alone at the federal level is going to hit over $40 billion this year, just to pay the interest on the debt. So I don't think governments have got the ability. Thus, we've got government out offering dental care plans and pharmacare plans, and already running a $45 billion deficit. They ain't got any more money.
That was a
And
pretty
that
sobering.
was not a political statement. That was just
I was going
fact.
to say, that's a pretty sobering comment there, Michael. $1 in 1981 could buy more than $1 today. How does this loss of purchasing power over time factor into your conclusions about the increase in property values?
Well, there was one slide back at the beginning that you may recall looked at the average return on various investments going back to, I don't know, 1928. And it showed that the average inflation over that period of time was 3%. But the increase in the value of real estate was 4.2% over that same period of time. So real estate has not only kept up with inflation, it's actually better than inflation. So you've been better off owning real estate over that long period of time because it went up more than inflation. So it really hasn't been an issue. It's been a winning situation for people. However, remember that the stocks in the same period of time went up something like 9.8%, which was double the return from real estate.
Now, your presentation is dealing primarily with what would you do today and in the short term, in terms of renting versus owning your own place. What if you own rental properties for income purposes with a 10-year horizon? What is your opinion on gaining interest on the value, selling all the properties versus continuing to rent the properties? That's crystal ball gazing.
Yeah, that's, there's a famous commentator who once said, it's very hard to make predictions, particularly about the future. And who knows? I've learned over years of investing, and it applies to real estate and everything else. There's two kinds of investors. There's the ones who don't know what's going to happen to the market. And then there's the ones who don't know that they don't know what's going to happen to the market. And in fact, to think about, there's a third type. There's the ones who know they don't know, but because of their jobs have to pretend that they do. So I don't, I would say, I guess, if you've got a situation where you've got positive cash flow and you're making a reasonable return, something in the order of 5-6%, net from those properties, then that compares pretty favorably with what you can get through other investments. So I think what it comes down to is is the return I'm getting on the rental properties now equal to what I could get through investing in, let's say, blue chip dividend paying companies? And after taxes, am I better off? One of the problems with rental income is that it attracts the highest tax rates, the same tax rates that interest or income get taxed at, where with dividends, it's taxed at significantly lower tax rates. So it depends on your personal situation, but I guess to sum up, I'd just look at the basic return I'm getting on my investments and see if it competes favorably. But trying to figure out what may happen over the next 10 years in the markets, yeah, not a place I'm going.
All right. Earlier, Michael, you made reference to the downside of owning properties and the role of the tenancy board. But another participant has pointed out that the delay in tenancy board hearings also disadvantages good tenants because landlords can ignore their responsibilities to provide proper maintenance. So tenancy also carries risks. Any
Yes,
thoughts on that?
indeed. Well, we mentioned that in the presentation that if you've got a bad landlord or a building that is in a negative cash flow situation, those landlords aren't going to spend any money. You know, um, I know in Toronto, there's thousands and thousands of condos that are in negative cash flow because people bought them when prices were high, thinking that they were going to Airbnb them or whatever. They can't Airbnb them anymore. They can't get the rent to cover the costs. They're not going to spend any money. They don't have it. So yeah, it's a risk. But no, I guess the only thing you can do is try to ensure perhaps that your landlord has got a good reputation by Googling them and perhaps stay away from brand new buildings where somebody has recently purchased because they may well be in a negative cash flow situation.
All right. Now, here's another question from someone who's clearly on the cusp of making a decision. They want to know whether they should pay down their mortgage. The current rate until 2025 October is 1.74. They have the opportunity to pay down two lump sum payments of $35,000 before the mortgage needs to be renewed. Do you have any advice?
You said that they're currently at 1.74.
Yes.
The question would be, well, why would you pay this mortgage down at 1.74? Because you could take that money and even just put it into a GIC and get 4.5% and be better off and have absolutely no risk. So, normally I would suggest pay it down, get rid of it. I guess it depends on the individual. And I know in my case, a number of years ago, I had a situation where I had a very low mortgage, and it was one that it was an open mortgage. It was an open adjustable rate mortgage, which I don't think you can even get anymore. And I came into a significant amount of money. And even though my mortgage was very low, I decided to pay it off. I just wanted to get rid of it. And so I did. So it's very much a personal situation. But yeah, if your mortgage rate is that low, then you might want to think about just investing the money into something that's going to mature at, say, the same time that your mortgage has to be paid off, and make an extra couple of percent for the next year or two.
Thank you. Now, you've made several references to the need of getting a good financial advisor, particularly if you're going to sell your property and rent. Can you give us a little bit of information or advice on how do you find the best planner? Are there particular qualifications for a best planner? And why is it so much better to use a certified financial planner than a bank?
Yeah, well, those are good questions. First of all, you should only use somebody who's a certified financial planner, a registered certified financial planner. And the reason is that they are just about the only ones in this country who have what is called a fiduciary responsibility to treat your interests first. And virtually no one else has, and which is outrageous, quite frankly. And so that's the first place to start. Make sure that the person is a registered, certified financial planner. And there's a lot of people who use other designations, CIM, but other things. But the real key one is certified financial planner in Canada. Why not your banks? Well, the banks have two problems. First of all, virtually none of those people selling you investments in your bank branch are certified financial planners. They will have other initials. Some of them are almost, given after like a 3-week course. So that's one reason they're not certified financial planners. But by the way, a certified financial planner course is intensive. I did it. It took me 3 years to complete it, going to school at nights. And I'm not a registered certified financial planner because it then requires you to work in the industry for 2 years after you pass all your courses before you become certified. So I never did that. So I am not a certified financial planner, although I did do all the coursework. People in your bank branches are not. The other issue with bank branches is they have a very limited pool of things that they can sell you, invest you in. And they are either GICs or high-priced, poorly performing mutual funds. And most of these banks today are only selling their own funds. So if you go into a TD bank branch, that's what you get. You get TD mutual funds. And over time, 95% of these underperform the market because their fees are so high. So those are the two reasons why you shouldn't go to your bank branch. And in fact, I'm talking to Linda from the association about a webinar I want to do in the future called Fire Your Bank Investment Advisor. But that's coming later. Now, going to the more difficult question, how do you find a good advisor? It's tough. It is very tough. The best way is to ask other people, talk to other people, see who they're using, see who they're happy with. And then there are some discussion boards and things, on the internet. If you just Google, best financial advisors, certified financial planners, you'll get a list of people that you can then go and check them out online, see what people say about them. Google is wonderful for this sort of thing. And then go see them and talk to them and find out if they're right for you. But the best way is probably talking to people who you think are fairly sophisticated investors and who are using a financial planner and find out who they're using.
All right, thank you. And I would just remind participants that these views being expressed are those of Michael and don't represent the association, etc. We'll have time for one more question, and then we'll have to bring things to an end. But if you have further questions, please submit them to us and we will pass them on to Michael. In the past couple of years, domestic investors have accounted for about 30% of new home purchases, as opposed to owner-occupied buildings. There's no doubt that this has also contributed to the increase in prices. It seems to me that if this investor demand softens, long-term returns on real estate are grim, unless first-time owner-occupied purchases step up to the plate. How does your analysis reflect changing demographics, i.e. disposable income of first-time home buyers?
Yeah, well, that's a very good point. I mean, the fact is that families can't afford to buy a first home today. It's just outrageously expensive. And that is obviously going to affect things. On the other hand, though, two important facts to keep in mind. Number one, how many new immigrants are coming into the country and how many of those come in after having sold a home in, say, China or wherever it might be. And, because a lot of them are coming in with substantial amounts of money. The other thing to keep in mind is that housing construction in this country is horribly, horribly underdone. the number of new housing starts this year is no more than we built in 1978, I believe it is, 78. The number of new construction starts has not increased, despite the fact that the country is up about 10 million people. So Canada has actually, amongst developed Western countries, one of the lowest ratios of housing units to population. And it's not getting better, clearly. And in fact, this year, housing starts have dropped again because the price of construction is so high. No one wants to build anymore because they can't make any money at it. So what does this mean going forward? You put it all together on affordability, but lack of units, high levels of immigration. Pretty hard to figure out what it all is going to mean in the end. I guess my best thing that I would say is, you know, I have a younger daughter who is currently renting. And what my advice to her would be is, let's see if there's an opportunity. Let's see if there is another major price correction. Let's see if prices go down another 18% or so. And if there is, let's see if that's a good time to get into the market. But right now, there's no way she could afford it. So hope that helps.
Thanks, Michael. And as I mentioned, we'll have to cut things off now, but if you have any additional questions, please, and those we didn't get to answer, please send them in to us and we'll forward them to Michael. So I'd like to thank Michael very much for his presentation. As I mentioned earlier, his webinars are always well subscribed, and today was an example why. I want to remind you to keep an eye out for our follow-up email, which will include information on how to access the recording of today's webinar, as well as a copy of the presentation slides. Remember, you can invite non-members to attend our webinars and try us out as a guest. To register for upcoming webinars, please visit the Ottawa Branch website. We will include our website address in the follow-up email. Thank you, and see you at the next webinar, which will be tomorrow at the same time. Meg Stickle-Croker will be leading us on heart health, workout, and tips. Merci beaucoup et au revoir.
Merci. Thank you, Paul. Bye.